Welcome to the Ecommerce Finance Podcast. I'm Stephen Brown with Ledger Gurus. Today I have Mark Lupton, who is the founder, director, and a CFO, a fractional CFO with Greenhouse Business Advisors. Mark, thanks for joining me today.
Glad to be here, Stephen. Thanks so much for having me.
So Mark, we've gotten to know each other. We have some mutual customers, and we've had some great conversations. Before we dive in, we're going to talk about strategic finance today. But before we dive in, tell us a little bit about how your background and how you got into e-commerce.
Yeah, absolutely. So Greenhouse Business Advisors got started 4.5 years ago. But before that, I was working as an analyst in a fractional CFO firm. And I learned a lot about the ins and outs of e-commerce, the ins and outs of consumer brands, and what to look for, what drives growth, what drives success, what drives failure, oftentimes too. And through a course of a few years, I ended up becoming a partner in that firm and then broke off and started Greenhouse myself. And that was 4.5 years ago, like I said. And so over that period of time, we have grown to serve over 30 different clients, and we have a team of about 4 CFOs. Some are joining the team now, and even in the process of hiring another right now. And so that's sort of the foray into e-commerce and a little bit about Greenhouse.
Awesome. We want to talk about strategic finance. And when we were preparing for this, we decided let's talk about kind of a long vision. And one of the hardest questions to ask any owner, founder, what is your exit strategy? What is your plan? Tell me, why do you start there?
The most important thing for a business owner to understand is what they want from the business. Oftentimes they think about what they want for the business, and that is most pressing and very clear in everyday operations. You want the business to grow, you want the business to become larger in size, you want it to have a larger impact, you want to have more sales, you want to hire more people, etc. But the question that I often see missed is, what do you want from the business? What lifestyle do you want from this thing? What's the dream that you have for yourself in 10 years, 15 years, 20 years? And so the answer to that question may be very different than what the business is trying to become. And if there's a big difference between those two things, it creates a level of tension, a lack of clarity for the organization, internal tension for the founder. And ultimately what the founder wants from the business drives strategy. It is the end game. And so that's why I start there, is because I've seen it really create an untenable tension inside of a founder and create a lot of lack of clarity, a lot of decisions that are not aligned with a consistent set of values and direction. And as a fractional CFO, if I don't know clearly where the company's trying to go, then I can't serve the business as well as I need to. And so that's the biggest reason why, I'd say.
And it's a hard question to answer. Like, do you know what you want from the business with Greenhouse? If I were to ask you that question, do you have an answer?
I do.
Oh.
And well, I will say I have an answer, but I do think that the most important part about that question is not having the right answer, but having an answer at any given time, so that you know what you're aiming for and that it's not subconsciously driving you, but it's driving you consciously. It's in the foreground. And so for Greenhouse, what I want from Greenhouse personally is not some big exit to PE necessarily. There's nothing wrong with that. I think that's a fantastic thing. Truthfully, it's not even financial. It's financial in so much that I can provide a good lifestyle for my family and provide for my family's future. That's what I want from Greenhouse financially. But really what I want from Greenhouse is something that it can't fully give, which is some level of fulfillment in what I'm doing. I want to do meaningful work that has a meaningful impact on the business owners and those in their care and under their responsibility. That is what I want from it. I want it to bring me a level of purpose, fulfillment that only a type of work can bring. And there are, of course, other things that bring purpose and fulfillment that are far beyond work, but that is certainly a key part of it.
Give me an example that you've seen where there's a disconnect between what a business owner wants from their business and how they're operating. Like, do you have a tangible? I mean, obviously we want to anonymize, but any example where that disconnect has caused issues?
Yeah. So I was working with well, I guess we're still working with them, but I was working with a founder of a consumer goods CPG particular company that had a strong Amazon presence and wanted to get into retail with this idea that this is a retail product. This is what the thinking was. This is a retail product. And so we really need to get into a lot of doors. We need to get into a lot of doors across as many regions and chains as we can. And we need to do that relatively quickly because, well, there's competition that's going to, fight against us. And so we need to expand quickly. And the way that they wanted to do that was going to require quite a bit of outside capital, quite a bit of necessary loss of control, and a lessening of their ability to steer the direction of the company. And well, once you get on the venture capital treadmill, it's very hard to get off. And so that was a pitched strategy, an operating strategy in mind. When I asked about what the business owner pictured for himself in 10 years for the company and what he wanted from it, the answer was a lot different than that strategy, which was, I'd like to create a legacy business that I can see my kids working in. There's a natural difference between those two.
Yeah.
One requires a level of control and a growth strategy that enables that to happen. Another one requires a loss of control for the sake of large financial growth. Neither are inherently better than the other, for instance, right? But they're competing.
Gotcha. No, that's a great example. Now, let's say you know what you want long-term personally as an owner. What other long-term things do you ask a customer?
I'll ask about, I'm going to keep going through the founder's lens, okay? So I'll ask about where they envision themselves. It sounds kind of odd for a fractional CFO to ask these things, but I think it's directly tied to financial strategy, and that's why we're talking about it here, right?
Yeah.
Close your eyes and picture the desk that you're sitting at, the people that you're walking around, the activities of your day in 5 years from now. Do you picture yourself in a corner office of a building with a bunch of people? Do you picture yourself at your desk in your room? Do you picture that you're making phone calls? Do you picture that you're in spreadsheets? What do you picture for your life during that time? And you can actually, when you really parse that out, you can hear a lot of assumptions, a lot of structural assumptions around the businesses, what the business would have to be like in order to support that. And so I'll ask that. That's another more personal question. Other things I'll ask, and again, we're shifting from the what do you want from the business to what do you want for. So what do you want from? Those are the types of questions. What do you want for the business is a different question. There are a lot of things that dictate enterprise value growth, a lot of things. And it's not just the financial statements and what they show. Warren Buffett talks about the moat. Everybody's heard about this before, right? It's not just the financial statements that generate that value. And so we want to think about all the different parts of the business that need to be strong in order to raise that overall enterprise value. And enterprise value really just is a proxy for health in many senses. I think in the best senses, that can be argued, but in the best senses, it should be a proxy for the health of the business. And so we'll think about things about competition. We'll talk about go-to-market strategy with different products. We'll talk about what channels, product lines, talk about the types of margins they'd like to see, and things along these lines as what do you want for the business?
Okay, so with that, when you say long-term,
Mhm.
what do you think about? 10 years, 20 years, 30 years?
I think about generally 10 years is where I think for long-term. And this is not a standard that I'm saying you should have, but I do think about 10 years because it's another life stage. 5 years feels like you could live in the same life stage and be 5 years from now, depending on your life stage. But 10 years is like a jump in life stage. So generally people are thinking about that's a far enough a distance of time away to where I'm thinking about, am I happy doing this then in a new life stage? So that's what I'm normally thinking about. And again, I'm operating a lot in the question that is, what do you want from the business as a founder?
I agree with you. I think 10 years. We use EOS, Entrepreneurial Operating System, here at Ledger Gurus, and they talk about a 10-year vision.
Yeah.
And sometimes I'll ask people, hey, where do you want to be individually 10 years? It's kind of hard to wrap yourself around 10 years, let alone 20 or 30.
Mm-hmm.
I think that's probably a good time horizon. Plus, you think about things, how much change can happen in 10 years. 10 years ago, just looking at e-commerce, it was really entering this era of, I would say it's e-commerce 2.0, where Shopify and Amazon sellers, like, I think those technologies have been around a little bit longer, but really kind of hitting that sweet spot. And think about, we had this huge ramp, and then the last couple of years have been really hard. And then 10 years before that, 2005, or even, you were still building, there was some platforms, but it was still very raw. Like the customers I've worked with from that era, sometimes they're still on really old homegrown tech. And then 10 years before that, like you're building servers, right? It was like Amazon and eBay were e-commerce. And so, yeah, I think when you think about just from the business landscape, how much can change in 10 years, it's hard to envision beyond that. All right, let's kind of take it a step closer. So let's say you have a sense of where you want to be in 10 years. Let's say, hey, I want to have a profitable business that I could sell. I want to have an exit in 10 years. And now I bring it into focus a little bit closer. Let's talk about medium-term planning. What do you think about when you're thinking about medium-term planning? Maybe like, I'm going to lean on EOS because it's the framework that I use.
Sure.
They talk about 3 years, right? Thinking about things. And they talk about how, when they talk about a 3-year picture, they're having you kind of imagine qualities. And I find that people can think in 3 years a lot easier than they can in 10 years.
There's a lot more specificity you can have.
Yeah, 3 years, 5 years. So what do you think about when you're talking about strategic finance in a midterm?
So, first of all, I'll just say that I think that long term is fun and imaginative, and sort of engages the heart of what you're doing. It reminds you of why you're in it. And so the challenge is to rewind that clarity that you have about what, and rewind that into the present. And so you take steps back. So you go from 10 years, maybe back to 3, back to 1, back to a quarter, like in the EOS. And so when I'm looking at 3 years, I'm thinking about the broad enterprise value drivers and how to grow the strengths and also shore up the weaknesses. So when I'm looking at a consumer goods brand, I want to look at their dependency on certain channels, their dependency on certain advertising channels, their dependency on certain products, their dependency on certain suppliers, their dependency on certain people. And those areas oftentimes will show me where there's a level of risk or opportunity in a business. And a lot of times, properly addressing those and seeing those in a fully realized, improved state takes 3 years. It's not as simple as just turn a light switch and all of a sudden you're running on Amazon. And you've got a fully ramped up Amazon store. It takes time. And so or the other way around, if we have a level of dependency on Amazon and we'd like to transition that to having customers purchase through our website as a more dominant sales channel and owning our customers in that regard, that is a long journey. And so depending on your product and situation, et cetera, right? And so I'm looking more so at the broader enterprise value drivers and trying to understand which of those things can we see improved and make a list of them all in a relatively ideal state. And I think 3 years is enough time to get to that place. What about you? I'm curious what you think of when you think of 3-year planning.
I think you get into more tangible outcomes. I mean, I've done 5-year pro formas when I was in tech, which I thought were these wild works of fiction to a certain degree, like A and B and C. But I do think you can think about tangible outcomes that are going to take some time. There's a quote, I think it's from Bill Gates, that says most people overestimate what they can do in a year and underestimate what they can do in 10 years. And I agree with you. Like if we're thinking about e-commerce, you're not going to launch into a channel and have a lot of success in 1 year. But in 3 years, you should have some traction, right? You should have some level of results. And if you don't, maybe you need to rethink that initiative. So, product lines, it takes time. Great product can take years to develop. Supply chain orders, you're looking oftentimes at least a year. So I think when you're thinking about a 3-year, I think it's good to have like a roadmap of, hey, here are the products that I'd like to add or the channels I'd like to get into, and, have some specific plans, as well as maybe not the things you're not going to do. So if somebody came to me and say, yeah, I'm on Shopify today and I'm going to expand into Amazon and wholesale and TikTok shop in 3 years, I'd be like, okay, how much capital are you going to raise? The key to going fast is usually funds. Like money can accelerate things, but this is not an industry that has a lot of investors at this point. And so I think you have to be realistic about what you can do versus what you can't do.
And what you should do, what you ought to do. There's a lot of things that are sort of eye candy to the consumer goods founder. Channels, there's a lot of conversations that happen across brands and across founders about what they're doing and what they're trying. And there's a lot of really, really good information that you can get from being in a community of founders. There's nothing quite like that. And you have to assess the priorities and the things that'll be most effective for your brand and what your brand needs the most, independent of others in some sense. You can't copy and paste the sort of roadmap. You can't copy and paste channel expansion strategies, product expansion strategies. It's not copy and pasteable. There are similar things that you can draw from very similar brands, but ultimately you have to look at the uniquenesses of your brand, your positioning within a broader market, and understand where the gaps are in your own company positioning and try to fill those and then prioritize them. I think sometimes a hang up that founders can get into in their 3-year planning is essentially saying, well, I'd like to see everything be better. I'd like to look at every single part of the business and all of it be better. But we have to ultimately prioritize and choose what are the most important pieces. And I don't know that, as I think about it now, I don't know that a lot of founders even have a toolkit for prioritization of channels or prioritization of operational opportunities for improvement. And so oftentimes a framework, I don't know if you've heard of this before, but there's a framework called Porter's 5 Forces.
Mm-hmm.
Have you heard of this?
Yes, I have.
It's a very common one for those in the business schooly world, but it's not as common in consumer brands. But it talks about the different competitive forces that could impact your business. And most people, when they think about those competitive forces, they think about rivals, existent rivals. They don't think about things like the power of a supplier, if you're overly dependent on one supplier, or the power of a customer base. If you're selling primarily into wholesale retail, how much power does that one retailer have over you? Think about new entrants or other replacements. What are people doing instead of buying your product? They might not be buying a rival's product. They just might be doing something that's different. And what is that? That's an example of a framework that people can look through and identify and help prioritize which things that they want to see grow in their business over the next few years. And I've seen that be relatively helpful.
Now, I know you've got an MBA, right?
I do.
And I have an MBA. Here's a little aside. If I were a recommendation, like I'm assuming you did case studies in MBA school.
I did.
So, which is really common MBA school thing is like, hey, let's study this business. There's a podcast I got into in the last couple of years that I think is the best case study podcast.
Oh, really?
And have you listened to the Acquired podcast?
I have.
Like, I'd just be like, go listen to this. Pick a business you're interested in. They used to just do tech. Now they branched out into just big successful companies. And I'd be like, just listen to that and think about how to think about a business, because those guys dissect. They do. It's a really cool podcast because it's like multi-hours. Like, buckle up. It's long, but it's really interesting because they tell history and they'll tell all the strategic decisions and they'll do like that analysis at the end. And I'm like, this is better than any case study that I did in business school. And a lot more interesting.
Absolutely. Yeah. You said something in there. Think about how to think about your business.
Yeah.
Operators often, out of necessity, need to operate one foot in front of the other and do that really effectively for a long time, endurance and resourcefulness. But as much as MBAs and business schools get, trashed on,
Hmm.
one thing that it did help me with was um, making sure to see the forest through the trees, right? And being able to have tools or lenses or filing folders, however, whatever metaphor you want to use, right? To address the broader issues of the business and keep those front of mind. So, how do we take long-term, broad, enterprise value related questions and keep them front of mind? That's part of what EOS tries to do. It's part of what we're talking
Yeah.
about doing here.
That's what I like about EOS is like you can read the books. You could really just read
Mhm,
traction and get a lot, but if you want to go a little bit deeper, there's a handful of books. And I
mhm.
feel like it gives you a strategic framework for those who don't want to spend a ton of money. Well, even MBA school, I don't know about you, but I thought they were pretty good. I think I got more strategic experience working in bigger tech companies, where because that was where I was before this world.
Mm,
I lived in enterprise software and we did strategic planning up the yazoo.
yeah.
And I learned a lot through just doing it. When you're dealing with these big product lines and big decisions, doesn't mean you're going to be successful. I could tell you lots of stories about failure, but I feel like there's power in strategic thinking. There's also power in the intuition, which I think a lot of founders have. They're intuitive, they're
Yes.
action oriented, and that's good. But you get bigger, your intuition can be right, but the problem is now you're probably trying to move a group of people, not just yourself, and you're trying to get them on board, and you're trying to think through more complexities. How do we do this? Right? It's not as easy. And so I think being strategic about and thoughtful about what it means to do, like let's say you're launching into retail. Well, let's just go get into Costco, or let's get into Nordstrom's, or there's a lot of things you got to think about.
Hmm. And a lot of people to coordinate work between and to motivate, and not just motivate initially for an initial push, but
Hmm.
to motivate and keep aligned on a week to week to week to week to week basis. And it makes it all the more important that you believe that you've made the right decision and seen it through different lenses and prioritize it amongst other things that you could be doing. You talk about thinking on the business, and I want to grab onto that theme again. Just it's very easy to get two biases that I've seen: recency bias and confirmation bias. Recency bias being you're over indexing on things that have happened within the last month. And you're saying these things that have happened within the last month are likely to continue. And so I'm going to make a decision based off of something that's recent. And I'm going to justify my action based off of something that's recent. And then confirmation bias is saying that I want to confirm what I already know. And so I see those things happen, and those ways of thinking create bad decisions. And ultimately, strategy is trying your best to make good long-term decisions and execute on them. And so I think there's these thinking pitfalls is really what we're talking about with strategy. How do you think about the business overall, long-term? How do you think about the business in the way that you make decisions? And where are you likely to steer the business in the direction it shouldn't go without knowing it?
And I think if you look at businesses as they get bigger, strategic planning and strategic finance
Mhm,
become more important because you're dealing with a larger organization, you're dealing with larger resources.
mhm,
And I think there's a balance, right? You kind of need that entrepreneurial intuitive thinking, to avoid being stagnant, but you also need to be strategic to think about, okay, well, what's next and what's after that and what's after that.
yes.
And I think some founders, you see some people that can go the distance, and you
Mhm,
can see some people that can't, that they're really good at a certain level,
mhm,
certain size. And when you can know what you're good at, sometimes it's like, hey, maybe I'm not going to be good. I mean, I think about this all the time. Am I going to be good getting to the next level? Am I, I've operated, I've been an employee in companies this size, but can I lead a company this size? Am
mhm,
I the right one? There's some guys here. I mean, I'm out of Utah. There's two guys that they don't get a lot of press. They get some. But one of the things that's cool about them, they've been serial entrepreneurs. And I've heard them on podcasts. They don't do a lot, but they'll do a little. They kind of know what they're good at. And when they get to the ceiling of what they're good at starting businesses, and they take them to a certain level. And I think they get bigger with
mhm.
each one. They're like, I think we can go a little bit further. But they get out. We did what we're good at. Time to move on to the next thing. And they've done it over and over again. They're not household names. You kind of have to be deep in the business and tech community here to know who they are. They're getting a little bit older. But I'm like, that's really cool because I've heard them say they take it to a point and then they exit and start over. And I think one of the challenges I see founders is they're good starters. Are they good at running, a $0 business is very different than $1 million business, is very different than a $10 million business, and it's ridiculously different than a $100 million business. And it takes a different skill set and tool set. And sometimes you think you're going to enjoy it, and then you get to it and you're like, no, this is different.
Mm-hmm. You mentioned that those couple founders, they know who they are. It also insinuates that they know who they're not. And I see that founders oftentimes get in a pitfall way of thinking where they guide strategy of the business based off their strengths, which early on is necessary because you have to lean fully on yourself, but later on isn't necessarily the most helpful. And so it creates these big blind spots. It's easy to think about and dig into great detail into what you know and what you're good at. It's a lot harder to do that for things you don't know, but you need it more for things you don't know well. And so I'm talking a little bit now about the importance of measuring your progress and success towards goals, and also talking about strategy. Because if your background is in retail heavy or wholesale retail heavy CPG, but you've got a product that could do really well online, you're likely going to bring a team around you that could put together a great strategy to go into retail. But you might overlook on accident and with no bad intentions, you might overlook and not give enough thought to what channels might be best for your product to sell through. And I see that in all the time. I see that in, you'll see some dashboards from built within different companies where the founders put together a really robust like marketing dashboard in a spreadsheet from their past experience as a marketer. And when you look at their operational KPIs and ask about those, it's someone else does that, or they're not very well put together. It's the same way of thinking. It's a unfortunate way, but I've seen it get people into some trouble. And it's been helpful to ask that question: what is the case against your company? Like, if you're sitting on the outside of your company looking in, what is the case against why it's valuable or healthy? So why is it unhealthy? Why is it unvaluable?
Where will it fail?
Where will it fail?
Mm-hmm.
And oftentimes I think that question brings out some anxiety, it brings clarity, and ultimately a level of relief, because you can attack those things specifically if they need attention. But I know that a lot of founders live in a space where those things are pushed a little bit to the side and we're focusing in on our strengths.
Well, and you get in these groups and it's kind of that to the moon mentality. It's all upside.
Mm-hmm. Absolutely.
And you don't think, I mean, if we think about the last couple of years, it's just been there was many years of just growth, just awesome. And then the Facebook algorithm changes due to app privacy changes that hit the algorithms, supply chain channel issues, inflation, now tariffs. And you don't usually think about that stuff. So there's a book, Andy Grove, who was a seminal CEO of Intel and has had a big influence in the business world, not just the tech world. He's considered the father of OKRs. He has the book called Only the Paranoid Will Survive, right? And it's really interesting because 20 years ago, who would have thought that Intel would be in trouble? And now here we are in 2025, and they're on the rocks, right? They're really struggling as a company. Only the paranoid will survive. Assume bad stuff is going to happen and you won't be wrong. You might not know which bad stuff's going to happen, but you got to have kind of a balance, right? You got to have an optimism for, hey, we're going to do this, this, and this. Now, let's talk about let's just make sure our weaknesses don't blow us up.
Yes. There's a book behind your head on your bookshelf called The Goal by Eliot.
Oh yeah, The Goal's a good book. Yeah, read that in MBA school.
It's somewhere on my bookshelf as well. It talks about the theory of constraints. Theory of constraints sounds super business schooly. We're just gonna talk about business schooly concepts, I guess. But it was one of the most valuable ways of thinking about business that I have ever heard, and it really is the bottleneck concept. The idea that you only are able to move as fast as your slowest component. This is a manufacturing concept. So if you have a manufacturing line and there is one bottleneck, if you're trying to put a lot of resources to fix things that are downstream or upstream of that bottleneck, it's going to ultimately be a waste of money. And so the idea is that you put everything into alleviating that bottleneck. And so growth is a series of alleviating bottlenecks. And so in some way that relates to what you're talking about with paranoia. But where are the bottlenecks in my supply chain? Where are the bottlenecks in my marketing funnel? Is a way of growth. Where are future potential bottlenecks? And you can take that to the broadest way of thinking about your business and strategy. And I think it's actually a great approach to strategic thinking, the idea of bottleneck alleviation. And if growth is a series of bottlenecks being alleviated over and over again, then planning also should take that shape.
All right, let's bring it into a near-term focus.
Yeah.
1 year planning. Let me ask you a question. How often would you say you run into a business that has an annual plan of some sort?
Pretty often.
A small business. Yeah.
It depends on the size of the company. So we're oftentimes working with companies between 5 and 50 million in size. And the ones who are around 8 figures have some semblance of that.
Mm-hmm.
But the closer you get to 5, the less and less and less people have a real budget in place or an annual plan of sorts. They have general ideas about what they'd like to see done, a strategy of things that they're working on now and want to work on over the next few months. But normally it's not a process. And that's something that we come in and help execute, is that process and build that foundational process for the clients and for those brands. But I would say the larger you get more and more budget processes, and planning processes. That is to say, though, it doesn't always mean that they're good. And there is such thing as a bad budgeting and planning process.
I kind of have my processes that I've used. I've used EOS as a vehicle to improve them.
Yeah.
Tell me a little bit about some of the things you feel like a business should have in an annual plan, particularly around strategic finance.
Yeah. There are the obvious things: sales plan, marketing spend targets, marketing efficiency ratio boundaries, these sorts of things, hiring plan, overhead, expansion. If you have manufacturing, there's all sorts of things within that as well. If you're doing that in-house, I should say. Things that I think are more interesting are what's below the P&L. Oftentimes, the P&L is the main focus of an operational plan. And so when it comes to strategic finance, of course, it's important to have a P&L level plan. And what I mean by a P&L level plan is I mean that you have your sales, your profitability on your products, so your gross margin. You have your advertising expenses and other variable expenses that come out every time you sell a product, merchant fees, shipping, outbound, inbound. You have your team, payroll, G&A expenses, etc. So that's what's on the P&L. But that doesn't tell you what the cash in the bank is going to be. What tells you what the cash in the bank is going to be is a forecast of your balance sheet. I see finances and financial reporting and forecasts as just a story of your actions told in numbers. And so that story extends below the P&L. And that's where strategic finance comes in. And so I think also about the debt stack that we have, the interest that we're paying on that, the cost of our capital. Do we, in our growth plan, have opportunity to get cheaper capital, to consolidate? As we expand our manufacturing, let's say if you do self-manufacturing, how are we going to finance that equipment? Do we need to finance that equipment? Can we pay that in cash? If we have a level of treasury built up, if we have some liquidity built up, how are we letting that money not just sit, but we're either reinvesting in the business or making dividends on that through high yield accounts? These are the sorts of things that are balance sheet related and that are not P&L necessarily. How much inventory do we want to keep on hand? At what points in the year do we need to build up inventory? At what points do we expect to be lighter? When is that cash outlay going to come to purchase all that inventory versus when the sales will come in to offset it? All those are balance sheet and cash flow statement movements. And those things to me are vital from a strategic finance perspective, specifically.
I agree 100%. The way I think about it on the balance sheet, I think about, you talked about a couple of different plans. I think about an inventory purchase plan.
Mm-hmm.
I think about a debt plan.
Mm-hmm.
And some people are debt adverse. And I'm like, if you're using it to, there's a concept of the cash conversion cycle that I tell people, like, hey, you're
right.
You put money into buying inventory. There's a delay before that you can sell that inventory, before it reaches your warehouse. And then you have to sell that. That money has to come from somewhere, right? You can fund it to a certain degree out of profits, but there is a mathematical limit based on your profitability and your growth rate and that cash conversion cycle at which you cannot fund a business with profits alone. And so you have to think about, I'm trying to think what else. You talked about so inventory purchase, debt, kind of a debt plan. I think those are the key things for a consumer product business. There can be other things. But I did an episode a couple episodes ago with Alec, the CEO of Settle. And we talked a lot about financing. And, I really answered the question. He gave me a good answer for the question, because you always hear banks only want to lend you money when you have money. And his answer was like, it's a risk thing, right? Because when you have no money, they look at you as like, well, they're higher risk because they're not thinking ahead. They're not prepared to navigate potential downfalls. And so I think it's really good to have all those, know what you're going to need. And if you need more debt facilities, get them early. Because when you need them desperately, you're less likely to get them, or you're less likely to get the terms that you want.
Right. Try and qualify to get availability early when you can, so that you build relationship and trust, and even getting a few reps, taking out a little draw on the line that you qualify for, even if it's small and you don't need it, paying it back, letting the lender see that, building trust over time. It really does make a difference.
What else in a one? I mean, I think we've talked about a lot of tools. A lot of these plans come together in I call it a budget. Some people call it what do you prefer to call it? A projection, a forecast? Like when you're looking at a future looking profit and loss, what do you call it?
I think there's a lot of ways to look at it. The way that I look at it, when I think about projections, I'm thinking about 3-year projections. When I'm thinking about a forecast, I'm thinking about what our latest estimates are on the future, whatever that period is. I'm thinking about a budget. I'm thinking about something that you set in stone at the beginning of the year and you stamp it. You can adjust it, but it needs to be through a formal process in the middle of the year. But it is what we thought we were going to do at the beginning of the year. So you can see how far off you were. And you can assess, like we talked about earlier, what gaps in your thinking may have led to the differences from what you thought earlier in the year.
Which I think is a really important, this kind of leads us to more short-term strategic finance. You set a plan, you set a budget, nothing goes according to plan. There's a learning opportunity there to say, wait, where were we off? You're either going to be off positive or negative. Either way, there's a learning there. And my experience is when you learn why you're off and incorporate those learnings into the future, you do things better.
Yes. And the trap that people also often fall into is that the budget is irrelevant, so we don't look at it anymore. It's no longer relevant, quote unquote. It's not relevant in helping you maybe determine what year-to-date plus forecasts, together will estimate that our end-of-year totals will be. It's not relevant in forecasting maybe the next few months, but it's very relevant in teaching you lessons about how you think and how to operate the business strategically going forward. Very relevant. So I'll see a lot of budgets get made and get thrown to the side. And instead what will come is an updated forecast every single month so that we can know and plan for next month, the following month, and the following, which is really important to do. That's forecasting. But don't be so quick to crumple up your budget and toss it in the trash, because it has a lot of value for teaching you how to strategically run your organization. It's amazing to me. I'll just say it's amazing to me how far off you can be from a budget, and how hard it is to sometimes stare at that, swallow it, swallow that finding that you're so far off, and then take action.
Well, and to your point, like when you learn from it, my recommendation when people are thinking about budgeting is you just start. And you're going to be off. You might be wildly off. Even when you're good, you could be wildly off.
Right.
There's going to be market changes, and you weren't planning on them, and that's okay. But you've thought of, the process of planning and budgeting forces you to think about your business very closely. And when you run into those issues, you have a better understanding of how you can adjust. That's one way I think about it. The other point you brought up, and this is something that I do in our businesses, there's almost always a mid-year adjustment. We got off. We thought it was going to be A, ended up being B. Let's make a tweak. I rarely do more than one adjustment a year because it can be a lot of work to make those adjustments. So you do a mid-year adjustment, like, we muffed we missed hard, or boy, we underestimated demand. Holy cow. But I also see when you build these models, you have an ability to adjust because your revenue plan, a lot of times your marketing plan drives your revenue plan, which then determines your inventory purchase plan, which then is going to dictate your debt strategy. And so they cascade. And if you model these things nicely, you can make adjustments and say, oh, we're gonna go get some more credit, guys. We're riding the wave, but we don't have the credit to keep riding it. Or, oh man, we missed. Let's scale back our inventory, our next order, so we don't have all our cash locked up in inventory. Or those hires we thought we were gonna do mid-year, maybe we shouldn't do it. My last company was a private equity software business, enterprise software, and lots of finance people. Private equity loves to do budgets and finance, and it was very simple. Like when we were off, everything got cut. We're missing our targets. Cut back on spending. No additional hires. Right? They'd rein it in, and just the same thing I experienced in public companies. When things were good, go hire more people. When they were bad, no travel. They rein it in.
Right.
So I see these tools as something you can use even if you're off, make the changes and see what the adjustments tell you. And then you're like, okay, what decisions do I need to make?
Absolutely. I was going to ask you if you see that those things are applicable to smaller businesses.
Yes, absolutely. One of the first things I brought into Ledger Gurus when I came was strategic planning and budgeting, because that's what I was used to. I was like, oh, this is what we do, right? This is what businesses do. It was some work, and you just get better at it. But like I really, and there's been years we've been off. We've been way above plan. We've been under plan. But I think when you force yourself to ask the question, why were we off of our plan? Because let's just talk about both directions. If the opportunity is there, you're usually like, yeah, let's go for it. Let's get as much as we can. And if you're under plan, there's ways you can adjust. But ultimately you want to say, what did I do wrong? How can I learn from this? And when you do that, like you make better decisions in the future. You're just like, hey, do you remember that? We got off, or you're more thoughtful about how you approach things. And I like to think of this is what we think. Now, if you want to get really hardcore, I had a business that I had to kind of keep alive, and I did multiple scenarios. That was kind of my baptism by fire. I took over a small business and that was running out of money, and I did multiple scenarios, and every month I'd update my scenarios. Hey, what happened? And that's a lot of work, but it kind of helped me see potential outcomes for the upside and the downside. I would just tell people, have a plan. When you're off the plan, learn and adjust so you can make better decisions.
Absolutely. Before I went to business school, I was working in a large Fortune 500 company, and there was a lot of time spent on forecasting and planning. And it was a large part of our job. And we had a whole other job to do, which was actually deliver on that. But a lot of it was focused on forecasting and planning, and it was nauseum. Felt like it was overbearing and too much. In some senses it was, but it enabled us to see deviations and to operate versus our really fine-tuned expectations on a daily basis. And I do think that same concept applies. But oftentimes, I don't think that businesses get to it because the urgent always overtakes the important at an early stage. And that way becomes a habit of working and living. And the bigger your business gets, you maintain these habits I think the business grows faster than our ability to build good habits. And we need to proactively build habits in the same way we're proactively planning. And that's a hard thing to do when the urgent is very loud. And it also is a hard thing to do if you're not certain that you want to be the CEO. If you just want to be in it for a few years, this is just for a few years, a few year sprint, then you may not think it necessary or worth your time to learn how to become the leader of the next phase of your business now. But it's very important.
And I think every industry has financial constraints and key levers. And in consumer products, it's inventory versus cash. How much of your cash is going to be tied up in inventory? I think it's understanding your different profit margins, your gross and your contribution margins, how many dollars are left over after your cost of goods sold and your variable sales cost, and then being tight with your OpEx. Don't run a lifestyle business. I've seen when things are good, you see a lot of big offices and kind of extravagant, unnecessary expenses in a business. You see that's more common. Running a tight operating expenses empowers you to do more.
Absolutely. Frees you up to invest in the next phase of the business.
So we've been talking a little bit about how the 1-year plan transitions into the ongoing. What are some of the other short-term execution things, maybe quarterly, maybe monthly, that you think are really critical around strategic finance?
Yeah. Well, the first rhythm that I want to call out is another EOS rhythm, and we should, I don't know if you're sponsored by EOS yet, but
we should be.
It's getting to that point in this episode. But every quarter, setting quarterly goals, the rocks, all the different terms you can use to define what you want to accomplish in a quarter, and tracking on a consistent basis against that is so huge. From a strategic finance perspective, what you can be doing on a quarterly basis is what you should be doing on a monthly basis, with extra emphasis on at the quarter end as well, which is the financial review, where you're looking at your expectations versus what actually happened, and going line by line through those financial statements and understanding the differences. And if you forecasted and budgeted, to get our terms right, the P&L and the balance sheet, each account should have an expectation, and each account has an owner. Somebody in some way or another is responsible for those numbers being what they are. And so if there's deviation, there's explanation behind that deviation. And so every quarter, especially, do an extra deep dive into those deviations. And at the half year, make the budget adjustments you need to, but still don't lose track of the reasons, the deeper, broader reasons why you may have deviated from that. So quarterly, the financial review becomes really vital, where you're comparing budget versus actuals and identifying line by line differences from what you expected. And biannually, I would love to see every budget be revetted and reforecasted if need be.
What are your thoughts on like a continuous budgeting, like 12? This is something I've thought about doing, but I've never done because it's so hard. Like you always have 12 months of budget. Have you ever seen that, done that? What are your thoughts on that?
I have seen it. It's not something that I'm always doing with clients.
It's hard to do.
It's kind of comes back to the forecast budget conversation. I keep a forecast that is always, pushing forward the assumptions that we put into it into a broader time horizon. So you could call that a projection, maybe, if we're going by my prior definitions. But I always have a financial model that is updating with actuals every single month. And then the forecast is sort of showing the results of those actuals being played out into the future, and that the assumptions adjust automatically and with some manual input. So I do have that always working for our clients, so that we can run different scenarios. And but that's different than having a budget that has been stamped. That to me goes back to more of a projection or a forecast that is updating itself on an ongoing basis. So I see those as different things.
All right, let's kind of have one final topic. And we've talked about this along the way, common pitfalls. We've hit a lot of them. What are some of the pitfalls that we haven't talked about that you would like to add to the conversation?
Yeah, let's see. We talked about blind spots, and I think that's a general theme. And you could take the concept of blind spots and apply it to different parts of your business. And blind spots and bottlenecks. Are there bottlenecks and blind spots that are there that you're not addressing in each specific part of the business? So it's a concept of thinking. Again, strategy in large part is thinking about how to think about the business. And so some of the pitfalls that I do see when it comes to strategic finance is with financing in particular. So oftentimes people will go for easier forms of capital as opposed to forms of capital that are right for their business. So classic example, this has been hit on all over the e-commerce finance content creation space at this point, but the whole MCA thing.
Yeah, merchant cash advance, Shopify loans.
Exactly.
It's easy.
So if there's new operators listening to this, there's always a new batch of people who are entering in and wondering about some of these different types of merchant cash advances, which is essentially very little underwriting is required, meaning your application process is super smooth and easy. You get fast access to capital. You don't have to show them your financials almost at all. And then you're paying back a percentage of your revenue every period of time, depending on the term, over every at some very high frequency for a period of a couple months until you pay back the entirety plus the fee. That is an unsustainable form of capital for growth. It is what I like to call a bridge. There's a difference between a bridge and a breakthrough. A bridge helps you go from one reality to another, and the other reality, the other financial reality, needs to be better than the one that you're bridging from, so that you don't have to rely on the bridge again. You can't have forever bridges. We can have a bridge to get us to a new solid foundation. And so a bridge would be like a merchant cash advance, where you're taking a sum of money out. It's very easy to access. It's incredibly expensive. They say the fees are 17% or whatever, and you don't know that that's not actually an APR. That's not an interest rate. That is just a fee, and you're going to pay that back. It's actually 4 times that, potentially 5 times that. And so it's very expensive, and you take that on and you get into cycle of the whole merchant cash advance cycle. You're running out, you need more, you keep going. If you see that type of loan if you're thinking about that type of loan as a sustainable working capital for growing your business, or as growth capital for growing your business, that is an inaccurate way of thinking about it. Lines of credit are totally different. So we could talk a lot about the different types of debt and healthy capital. Sometimes friends and family funds are very easy relatively easy to access, but the cost of capital there may be very high from a control perspective, or from a personal perspective,
a social perspective,
relationships.
Yeah.
And so I see, from a strategic finance standpoint, people making uninformed decisions about types of capital and not knowing what a sustainable form of debt would be, or a sustainable form of capital injection would be, versus just what should be only a bridge. That's one other hang up that I see more tactically.
Awesome. We could probably take each one of these topics and talk about them for an hour if we wanted to. There's so much to unpack, but hopefully this has given those of you that are listening a thought process about how to think about your businesses from a financial standpoint, and overall more strategically. Mark, if somebody wanted to connect with you, what's the best way to do it?
Absolutely. Well, my email is mark@greenhouse.business. So I love just talking directly with founders and anyone who would want to talk shop about these types of things. And we were pretty high level in some concepts today, but I'd love to get more detailed, if anyone would like to. Additionally, you can go to our website, greenhouse.business. So www.greenhouse.business, and find us there as well.
Awesome. Well, thanks for joining me today, Mark. It's always good to talk.
Thank you so much for having me. It's a pleasure.
Today's episode is brought to you by Ledger Gurus, your go-to team for e-commerce accounting. We handle everything from keeping your books in order and tackling sales tax, to managing your inventory accounting, and even acting as your fractional CFO. Basically, if it's about accounting, we've got it covered so you can focus on growing your business. Head over to ledgergurus.com and see how our team can help you level up your business today. That's LEDGERGURUS.com.